By now you understand the big ideas. What a stock is, what the S&P 500 is, why a cheap index fund quietly beats almost everyone. But two very practical questions are still standing between you and actually doing it. First, when you finally go to buy the S&P 500, which exact product do you click? And second, should you even stop at America, or should you buy the entire planet? Those two questions are today. By the end, you will know precisely what to press and how big to think. Let's solve the first one, because it confuses almost every beginner. You decide you want the S&P 500. You open your app, you type it in, and suddenly you are staring at not one option, but several, with strange names like SPY, VOO, and IVV. Panic sets in. Which one is the real one? Here is the calming truth. They're all real, and they all hold the very same 500 companies. They are just three different companies offering the same basket. Think of it like bottled water. The water inside is essentially identical. You are really just choosing the brand on the label. The most famous one is SPY, run by State Street, the original from 1993. It is the oldest and the most heavily traded, which makes it the favorite of fast-moving traders. Then there is VOO from Vanguard, the company Jack Bogle built, famous for charging almost nothing to own it. And IVEV from BlackRock's iShares, which is much the same story, rock bottom cost, same index. So what should you pick? For a long-term investor, the deciding factor is mostly cost, that tiny annual fee, because over decades, even a fraction of a percent compounds into real money. That quietly points most long-term investors toward the ultra-cheap options like VOO or IVV. Traders who buy and sell constantly often prefer SPY for its liquidity. But please hear the real lesson underneath. The difference between them is small enough that choosing the wrong one is a rounding error compared to the mistake of never investing at all. Do not let three letters freeze you. Pick a cheap one and move on with your life. Now the bigger, more interesting question. Should you stop at the S&P 500 at all? Because remember what it actually is. 500 companies, all of them American. It is the United States and only the United States. And the United States, as mighty as it is not the whole world. There are great companies in Europe, in Japan, in Taiwan, in India, all over the map. So a natural question follows. Why not on all of them? That is exactly what a global index does. Instead of just the US, it holds companies from dozens of countries at once, weighted by their size. The two most famous are the MSCI World and the FTSE All-World indexes. And just like with the S&P 500, you do not buy the index itself, you buy an ETF that tracks it. The most sweeping example is Vanguard's VT, the Total World Stock ETF, launched in 2008. One single purchase, and you own a sliver of nearly every public company on the entire planet. Diversification taken to its absolute maximum. Here is a fact that surprises people. Even when you buy the whole world, a huge chunk of it is still America, currently around 60%. Not because of patriotism, but because U.S. companies are simply that large a share of global value. So a world fund is not the opposite of the S&P 500. It is the S&P 500's companies plus everyone else in their natural proportions. So why doesn't everyone just buy the whole world and be done with it? It comes down to a very human tug-of-war. On one side is something called home bias, the natural tendency to overinvest in your own country because it feels familiar and safe. On the other side is the textbook argument for going global. Spreading your bet across many nations means you are not betting your entire future on one country's fortunes. If one nation stumbles for a decade, the others can carry you. And there is real history feeding both sides. For the last stretch of years, the American market has outrun most of the world, which makes the S&P 500 look like the obvious winner. But zoom out far enough, and you find long periods where other countries led and America lagged. The uncomfortable truth is that nobody knows which region will lead next. Past performance, as they are legally required to remind you, does not promise future results. So who is right, the America-only camp or the whole world camp? The honest answer is that this is one of the great respectful debates in investing, and reasonable people land on both sides. Some keep it simple and just own the S&P 500, betting on continued American strength. Others buy the whole world and never have to guess which country wins, accepting slightly lower recent returns as the price of sleeping soundly. Neither is foolish. Both are miles ahead of not investing or of gambling on single stocks. So let's gather it into one clear picture. Your first question, which product tracks the S&P 500, has a calm answer. Several do. SPY, VO, IVV, they hold the same basket. So pick a cheap one and stop worrying. Your second question, whether to go global, has a wise answer. You can own just America with the S&P 500 or the entire planet with a world fund like VT, and both are legitimate, sensible choices. The only truly wrong move is to let the choice paralyze you. You started today standing in front of an app, frozen by a wall of strange tickers and a nagging feeling that you might pick the wrong one. Now you can see what was always true. Under the confusing labels, you were only ever choosing between owning a cheap slice of America or a cheap slice of the world, and then having the patience to hold it. The ticker was never the hard part. Pressing buy and staying calm always was. I'll see you in the next one. Until then, keep it simple and don't let 3 letters stand between you and starting.